And welcome. This is Mary Ellen McGonagle with your weekly MEM Edge show. This is the show where we bring you where the action is in the broader markets, and certainly a lot of action. We're going to get right to it here and take a look at what we are going to be covering here today. As usual, we'll see where the markets are poised to close. We're about 20 minutes out from the weekly close, but we will get some good intel there. Also, take a look at some of the headline news that drove this market lower this week. Also, the fact that we are in a very difficult market. There's not a lot in the way of long opportunities, but certainly I'll share with you some hedging opportunities. And by that, inverse funds, and then a couple of defensive related stocks that are holding in quite well. So from here, let's go ahead and take a look at some of that news. The Federal Reserve did come out on Wednesday, announced a 0.75% hike in that Fed funds rate, and they targeted 4.6% as a potential peak for that rate. And within that as well, Fed Chair Powell was very, very hawkish in his comments, very firm. Again, this is following his Jackson Hole comments, the fact that they are not against putting the economy and actually consumers through a little bit of pain before we can potentially come out of this spot market and turn. We are in a period of very, very high inflation, and the Fed is targeting 2%. We are well above that level. So the news did, in fact, push the markets sharply lower throughout the week from Wednesday on. We did see the U.S. dollar. It is jumping at a near-term high on news of the Fed rate hike. And this is all about foreign investors coming in and purchasing the now higher yielding U.S. bonds. We'll talk about the impact of that. And then also we did get news that the leading index, it fell for the sixth month in a row, not what you want to see, certainly as it relates to economic expansion not taking place, but good news for the Fed, as this is what they are on the lookout as far as curbing growth and hence inflation. We did see the labor market remaining strong. We had unemployment claims rise a little, but again, underneath that, the labor market is strong. This is something else that the Fed is fighting. So kind of mixed news, but at the end of the day, we are in a period where inflation pressures remain quite high. Next week, we will be getting some additional numbers. Of course, durable goods orders will be released, consumer confidence, that second quarter GDP. That's going to be the final print. At this time, we are on track for 2 consecutive quarters of negative gross domestic product growth. And in some areas, that would be termed a recession already. So there certainly is talk that we are already in a recession, with this number certainly confirming that for some. Also, we will see a number of Federal Reserve officials speaking. They are on the circuit. I'm sure they will have a lot to say as it relates to their desire to quell inflation. They're on the march, so we could see certainly continued downside pressure on the markets as they continue to come out with these hawkish comments. So let's go ahead from here. We're going to take a look at the broader markets and see where did we close for the week. And here we are. This is a daily price chart of the S&P 500. A couple of areas that we want to pay very close attention to, and that is possible areas of near-term support. We can see that the broader markets are continuing to tumble lower. At this time, we are on track for about a 5.6% decline in the S&P. The relevance here is that we were looking at this mid-July period as a possible period or area of downside support. We have broken below that. The next possible area is this mid-June low. We are on track to potentially close below that. So from here, I will share with you the relevance of that, but let's take a look at these momentum indicators as well. We have this RSI, that relative strength indicator, now below 50 and trending lower. We are getting close to an oversold position. That's when it gets down below 30. And actually, we are at that 28 level. So we are in an oversold position. We can go back to this period last December where we did get into an oversold position and had a little bit of a bounce. So that could be something. If we did see that, I would be a seller into any rally, given the broader market dynamics and the Fed's determination to really do whatever it will take, in their words, to fight inflation, and will in turn bring the markets potentially lower. So down here, we have faster moving stochastics. We do normally, in any kind of an uptrending period, want to see that above 50. This is also down here in oversold territory. But again, any bounce, I believe, will be rather weak and an opportunity to lighten up on positions. So from here, let's go ahead. And I did want to share with you a longer term view of the S&P 500. So we're just going to take a minute here and take a look at this weekly view of the S&P. And the relevance here is sharing with you the fact that we did see that RSI dip into negative territory as we found resistance here at this 200-day or 40-week simple moving average. So if we go back historically on the weekly, it is showing us the 2018 bear market as well as the 2020. And we can see both of those bear markets were preceded by a negative RSI and a negative stochastics. We are certainly seeing that at this time as well. And we have seen it earlier in the year as we were heading toward that bear market status. The relevance is that an RSI turning negative on a weekly is not a common occurrence. So when it does take place, you will want to sit up. Take note, the stochastics are also negative. So more importantly, right now, let's take a look at those dynamics that are present when the markets do eventually bottom and come out of bear market status. And we are certainly early on the lookout for it, but you will want to be aware. First up, with taking a look at this 2020 bear market, we did see the stochastics turn as the markets began to level off. This is a weekly chart. And eventually, we are on the lookout for that stochastics to turn positive. Now, I will tell you, when we had this market bottoming and turning process, we did not need to see on the weekly the stochastics turn positive. Quite simply, this period here of consolidation and turning upward was enough. That daily chart is where you will be on the lookout for that crossover. It takes a bit longer on the weekly. And then likewise, we can take a quick look here at the RSI in that bottoming process period. We did get into an oversold on the weekly. And then from here, you will want to see that turn upward. The daily chart will give you that RSI positive, but on the weekly, at the very least, heading north. So that is the view on the broader markets. From here, I do want to share with you what is taking shape in the underlying sectors for the S&P. So what we are looking at here is a 2-month daily price chart view of those 11 sectors. I've added this RSI relative strength indicator. Going to go ahead and update that. But before I do that, actually, I did want to share with you a view of what took shape this past week, performance-wise, among those 11 sectors. So we're just going to take a minute here because I did want you to be aware that the energy group was down almost 9%, consumer discretionary, real estate, financials, and materials. Each of these areas are financially, they are very much impacted by the economy. So they're economically sensitive and they are declining. We'll take a look at some of the other reasons that they are not faring well, but this is a view of what took place this week. We can see up here at the forefront, mostly defensive consumer staples, utilities, and healthcare. Interestingly, technology is up here, the fourth relatively best performer, which I found interesting given that the NASDAQ is down about 6%. This is all about Apple and Microsoft faring better than the markets. They're down, but not quite as much. So let's go ahead and dive in, take a look at that 2-month daily price chart of these sectors. And we can see it's not a pretty picture, but what I did want to share with you again is that concept. Industrials also very sensitive to the economy. But what we want to be aware of here is the fact that these basic material stocks, that's XLB, we'll get a little bit more into this at the next segment, but a lot of this is that strength in the US dollar. In turn, it will push commodity stocks lower, and that's going to be that materials area with aluminum, steel, and any number of those commodity stocks tumbling as we are potentially heading into a recession. Other areas, I did share with you that energy got hit, and most of that was today, 6.8% decline. A lot of that having to do with Europe. They did come out with their PMI number today, and it was below 50. It was at 48.9. Any number that is below 50 indicates and points to economic contraction. So that concept of global recession is starting to take a little bit of shape here, and we can see this drop in energy names due to fear of reduced demand globally. So let's go ahead back, take a look at some of these other sectors here, and we can see what we can make of the market. At this time, we did have financials were holding in, but they are now in a deteriorating phase. I'm talking about going into last week's close. There was firming up, and we'll get into an area there, but we are seeing deterioration in financials as well. So not much to report elsewhere, although we can take a second here and just look at some of these more defensive areas, and you will see here we are with utilities. We are seeing buying on the dip. That candle is telling us. What we can do from here is just take a moment, dig into a 1-hour price chart, not a view that I use too frequently, but it can be helpful as it relates to looking at potential turnarounds in a given group, because we are seeing a lot of these areas that are very oversold. However, again, any kind of bounce I'm anticipating to be rather weak. So here's a 15-minute chart giving you that view that buyers, certainly at least for utilities, are coming in on that dip. We can take a look at some of these other areas here that are viewed as defensive. This is healthcare, XLV, and there are a couple of large cap pharmaceutical names that are seeing a little bit in the way of buying. But again, even defensive areas are not faring that well. Last up, we'll take a look at the staples area, and this is where I will be sharing a couple of stocks, but it is worth noting that overall, that sector group price action is not constructive. However, it is another area on this 15-minute where buyers are coming in on the dip. So we'll see where that takes us. So let's go ahead and journey on from here. We're going to take a look at ETFs that are very, very helpful as far as getting your arms around precisely what is taking place in these markets. So as we move through, I will share with you what we're looking at. First up here is the US dollar, huge jump today. And if we go into a longer term view, this is a monthly chart, you'll see just how elevated that US dollar is. That is going to continue to have other areas suffer. We talked about commodities, also emerging markets. So I'm going to share with you some funds, ETFs that are bearish on the emerging market space. So from here, the yield, we talked about interest rates on the rise. This is the 10-year Treasury yield. And another area of elevation, we are due to close the week at about 3.7. I'm going to pull up a longer term chart. In fact, we couldn't even do a monthly for this. And again, you'll see just how elevated this 10-year yield is. And of course, from here, I will share with you a chart of one particular area that gets hit harder as interest rates are on the rise. And so we will get into that. And let's go ahead and drill down, because we also want to be totally aware of volatility. This is that VIX index. We did have a spike up to that 32 level. And this is another area that is pulling back. We're kind of settling into the close here, but it is still quite elevated. During normal bullish phases, you want to see that volatility index in that 16, 18 level. And quite simply, at 30, we are well above that. So we can go back to other periods when we were seeing volatility index rise. This is the beginning of 2022. And then into the beginning of May, this rise in volatility is negative. You can overlay the broader markets, and you'll see that the markets would be in a declining phase as volatility is increasing. So let's move on, take a look at some of these other areas. I did write an article a couple of weeks ago about semiconductor stocks, SOXX. As semiconductors decline, so too does the broader markets, certainly the economy, simply because semiconductor chips are used in so many facets of the economy. If we go into this slowing phase with semiconductor demand, chip and equipment demand lowering, that is not a good sign. So I'm going to pull up, here is a weekly chart, and I can even broaden this out further, and we can take a look at a monthly chart of semiconductors. And quite simply, we can see that we've been in a generally upward trending growth phase for semiconductors going back to this 2013 period, a little bit of a consolidation phase here in the beginning of 2016. And then, of course, we had that 18 bear market and 20 bear market. But more to the point, when looking at a monthly and you see that RSI turn negative, not what we want to see as it relates to this semiconductor industry group. And of course, we can use historical precedents, again, going back to this 09, coming out of that 08, 09 bear market, where semis bottom before turning higher. So we will certainly, of course, at some point be on the lookout for that. And then one other area that I did want to share with you is the fact that small cap stocks are really getting hit this week, down the most, over, I believe, 7%, depending on where we close. And that is an area that had been holding in relative to other indexes. Small cap stocks are riskier. This decline that we're seeing this week really hits it home that the appetite for risk just is not there. So from here, let me go ahead and share with you a chart that is going to show Treasury yield. It is that 10-year Treasury yield. That's this line here, solid line. And then the bar chart is the NASDAQ. And I've shown this before, certainly bears repeating. This relationship as interest rates are on the rise, you will oftentimes, most of the time, see growth stocks in particular get hit the hardest. And it's all about rising interest rate environment is not good to as far as the valuation for future earnings in these growth stocks. So you can see the direct relationship as the NASDAQ is rising. It's during a interest rate lowering period. And then here more recently, since August, we have seen interest rates continue to climb. And of course, the NASDAQ deteriorating from there. So let's go ahead and take a look. I talked about some inverse funds and then also a couple of defensive names that are offering high yields and have growth prospects. So from here, let's take a look at EFU as an inverse fund. And this particular ETF is centered around non-US, non-Canadian markets. So it's going to be Europe, Australia, the Middle East. Now, of course, it did experience this gap up already, but I did want to at least make you aware of this. It is not worthy of chasing. At this point, it's more informational. We can also take a look at EFZ, and that is, in fact, EFU of note is that it is a 2 times inverse. And when you get those super powerful 2 times, when they fall, they will also be double what that inverse relationship is. So here we are with the pro short and the same market universe, Europe, Australia, Middle East, but it is not leveraged. So at some point in time, we can see on this chart, we've had other periods with these gaps up where you can see a continuation rally. However, this RSI near term is telling us that it is overbought. So it would be more similar to this February into March period when we get into an overbought, and you would want to wait for a pullback. Let's see if we can uncover any other possible ETFs that could be of interest. We did mention semiconductors, and SSG is an inverse, but again, a number of these are going to be leveraged. I'm going to go ahead and pull up a full quote here, see if we can get a bit more in the way of, yes, so the ultra short, if you see that before the name of the ETF, it is going to indicate higher leverage. So SSG is the inverse of those semiconductors, pointing this out because it was poised to break out of this base. Another area that we can take a quick look at here, or another ETF, is this Direction Daily Real Estate, DRV. Already has had a very nice uptrend taking shape. I'm going to go ahead and put in a 5-day simple moving average, and you can see where it's been hugging that, but it did break out of a base today. Again, we are up here in these overbought area at this time. So at some point, when we conceivably could see a little bit of a bounce potentially in the markets, then these leveraged ETFs, of course, will pull back and potentially provide another entry opportunity. PSQ is an inverse ETF for the NASDAQ 100, and it's another area that is finding support at this upward trending 5-day simple moving average. And we can see historically, this is the ProShares short. It's not leveraged. We can see that when it can get going, it can withstand, it can in fact have a nice lengthy rally. In this case, this was a 2-month rally for PSQ. And you can see the MACD now still in an uptrend and heading higher. So from here, I do want to share just a couple of names for your watch list. Not sure if anyone has a real appetite to load up on any names, but there are a few that are bucking the downtrend taking place elsewhere. General Mills came out with earnings today, and earlier this week on Wednesday, and they gapped up into a base breakout. And that is just not something you're going to see in this kind of a market, but it also took place on super high volume. In addition to coming out with strong numbers, the management guided higher with our growth prospects going forward. And it is all about individuals now cooking at home more in the face of high inflation, and they are anticipating that trend to continue. And we did get nice volume on that follow-up rally on Thursday. The stock pulled back very orderly to this upward trending 10-day simple moving average. We can see that MACD black line up through the red just beginning to enter into that uptrend. General Mills has a nice 2.7% yield. Another name that we can look at that is also in that consumer staples space is SJM. This is J.M. Schmucker and Company. And in talking about cooking at home, this is going to be all about your peanut butter and jelly sandwiches. But let's take a look at how the stock is finding support above each of its simple moving averages. And I talked about buyers coming in on the dip in consumer staples, and we can see that taking shape here. I'll just very quickly pull up that intraday to share with you that 15-minute chart. This is the sharp sell-off that we experienced in the broader markets. And then over the last hour, buyers coming in on that dip for SJM. Another name, nice yielder, 2.9% yield. And let's take a look elsewhere. And Hershey, not as developed. We can see HSY is attempting to break above these moving averages, rather myopic. RSI trending sideways, not quite ready for prime time, but worth being on that watch list simply because we can go back to this sharp rally phase in the beginning of this year. And that is certainly counter trend to the deterioration taking shape at that time in the broader markets. Hershey has a 1.8% yield. Next up here is Kellogg, another one similar to Hershey, where it is in the throes of potentially breaking above these moving averages. We did get that MACD crossover. If we can get up there into positive territory, that would be constructive. And then one last name here, actually, that is not holding in, but there was one other name that is in a nice confirmed uptrend, and this is Hostess Brands, TWNK, those of you familiar with Twinkies, but the stock is finding support at these upward trending, simple moving averages. And from here, we can see that it does not offer a yield. However, it is, again, in that nice confirmed uptrend. So I am going to leave it there. Everyone have a great weekend, and I'll look for you here again next Friday.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.